Common mistakes of seasoned investors. There's a tremendous value in studying mistakes. In fact, some of the smartest individuals alive today claim that they attribute their success to studying mistakes. Now, why would this be the case? It's largely because it is easier to be less foolish than more brilliant. It's easier to make fewer mistakes, recognize errors sooner, and fix them faster than to be more creative, more intelligent, and demonstrate more genius. The same is true for other esoteric concepts like happiness, affection, success, etc. What does it mean to be happy or to have lived a good life? This is a hard question to answer. But what's easier to answer is what will not lead you to happiness. Knowing what would make your life bad gives you a short list of what to sidestep and to put you on the path towards a better life. The same is true with investing. Since financial foolishness and investment mistakes are quite common, simply by figuring out how to avoid bad investment decisions, we'll be well on our way to making better ones. What do all investors share? The challenge is that there are an infinite number of mistakes we can make. So where do we start? I think the place to start is where we all slip up. Where is that? Where do all investors, whether they are seasoned veterans or amateur rookies, where do they falter? And the answer is in what we all have in common. Every single one of us has emotional needs, neural limitations, and psychological constraints. And this is not just with humans, but all living creatures. Edward Wilson was the researcher that discovered that dead ants emit a pheromone which summons all the other ants to gather the dead and deliver them to a proper burial. Wilson wanted to see how powerful this pheromone actually was, so he lathered this pheromone on living ants. And what do you know? There was a horde of ants that came rushing at them, loaded them on their backs, and took them off to be buried alive. Human brains behave in much the same way. Our minds are generally quite functional, but we also know that many times our minds send us astray in the form of behavioral gaps. As a result of these behavioral gaps and imperfections, the statistical reality is that most people are not going to make money with investments. The average investor invests at the wrong time and sells off at the wrong time. Without realizing it, they keep doing this over and over and over again. Virtually all investment mistakes can be divided into two categories: structural mistakes and behavioral mistakes. Structural mistakes relate to best practices, and behavioral mistakes relate to emotions and biases. Common structural mistakes. Just to give you a sense of what we're referring to, here are some examples of structural mistakes, which are usually made out of ignorance: overconcentration and overdiversification, poor planning and absence of process, reactive versus proactive decision-making, confusing information with insight, unrealistic expectations from our investments or investment managers, driving by looking in the rearview mirror, making decisions entirely by looking at the past, overpaying or tolerating conflicts of interest, insufficient due diligence, monitoring, and rebalancing. And there are many other examples, but these are more common examples of simply not knowing any better. And then there are the common behavioral mistakes. These are mistakes that even those with decades of experience and intimate understanding of capital markets will be susceptible to. We will spend the remaining time together delving into each one of them. Behavioral Economics 101. All of the behavioral mistakes we tackle today would generally be subsumed under the banner of behavioral economics, a fairly young field which studies the impact of psychological, emotional, and social factors on economic decisions. The basic premise of traditional economics is that a rational person and pure rationality is driving investment decisions. In reality, people are not purely rational, and it is largely emotions and biases that drive investment decisions. It is human nature to go with what feels good, to look for social proof from friends, to react to fear or greed in times of stress, and to make human errors of judgment. As a result, investment and economic decisions are not based solely on rational economic reasons, hence the behavioral mistakes we will now dive into. Base rate neglect. The first bias we tackle is base rate neglect. Base rate neglect is the human tendency to ignore the rate of occurrence and probabilities, and give much more weight to anecdotal data. Studies show that our brains are wired to respond to stories and very poorly attuned to statistics. Smokers are often the greatest examples of base rate neglect. Almost everybody that smokes knows that nearly 70% of all smokers will die of lung cancer. But almost every smoker also has an Uncle Murray or an Uncle Bob that smoked 1 pack a day every day and lived till the ripe old age of 96. Both may be true, but the fact that they are true is irrelevant, as one speaks to probability and one is a random anecdote. In investing terms, we may believe a particular investment manager is likely to outperform because he's smart and had an incredible performance in 2016, but neglect that this particular asset class is now overpriced relative to historical norms. Similarly, due to base rate neglect, we forget how few investment managers actually outperform, and that roughly 75 to 80% of the investment managers will underperform the index over a 5-year period. And once you factor in fees, that number is even higher. Another common example of base rate neglect is forgetting about inflation, which, without making any grand announcements, makes people 2.5% to 4% poorer each and every year. Anchoring. Anchoring refers to our tendency to rely way too heavily on the first piece of information thrown at us, which is effectively the anchor, in the process of making subsequent decisions based on the anchor. For example, if you're negotiating to buy someone's house and the seller throws out a crazy figure, the price you're going to consider attractive may be biased by that anchor. The same would be true if you threw out an extremely low price to start the negotiations. Examples of mistakes may include being anchored by unreasonable prices that were once seen as acceptable, but are now exceedingly costly. For example, paying 1% to a broker for custody services used to be normal in 2005, but today it's just highway robbery. If we were anchored on a price of something from the past, we should ensure that we don't assume something is still deemed reasonable when it ceases to be. Another example might be continuing to invest in an inflated environment or failing to sell just because we bought too high. To counteract that, researchers suggest that you imagine that you were away and somebody accidentally sold off your entire portfolio. With your entire account now sitting in cash, which investments would you repurchase when you come back and realize what happened? By forcing yourself to evaluate an investment only as if we're a new purchase, you avoid a bit of that anchoring effect. Framing. The term framing or frame dependence means that the way people respond to situations depends on how the situation is framed or presented, rather than on the actual facts of the situation. In other words, in making investment decisions, investors are usually more influenced by how the information is provided than what information is provided. Financial companies know how to market their products by appealing to these biases, being acutely aware that via the presentation, you can get the truth to tell any lie that you want. An example I see quite often is the variety of principal protected notes. Many of these principal protected notes seem to guarantee the principal of investments, give you all the upside with virtually no downside of the market. So investors pay exceptionally rich fees to invest in a vehicle and think that they have just discovered nirvana. Of course, if investors took a closer look under the hood, they'd realize that they are paying an arm and a leg, that there are considerably more moving parts than they think, and that the very people concocting many of these products are not buying them for themselves. To counteract falling for things like this, it's important to remember that every transaction has to have a party on the other side of the trade. And if something is so good, why would someone else, particularly an institution selling you the product, take the other side of the trade? So in approaching opportunities, always ask about the rationale and the motivation of the organization or individual presenting the opportunity. Confirmation bias. The confirmation bias speaks to our subconscious preference for accepting information that supports our pre-existing beliefs or decisions and avoidance of disconfirming evidence. This makes sense biologically because we are wired to feel before we think. And when our feelings are powerful enough, the facts tend to get lost in the background. This may make sense in a life and death context, But for investors, not responding to disconfirming evidence can be extremely dangerous. I can't help but remember how many Madoff investors said, "There's no way Bernie would do that to me." Or how many investors in Lehman Brothers or Bear Stearns claimed that their collapse was a virtual impossibility. Until it wasn't. There are actually 3 forms of the confirmation bias: seeing only that which is in our best interest to see, seeing only that which we expect to see, and seeing only that which fits our preconceived notions. Let's start with the first. In our interest. When we say we are only able to see what is in our interest to see, it refers to the idea articulated by Upton Sinclair's famous quote, "It is difficult to get a man to understand something when his salary depends on his not understanding it." Research shows that in a brokerage context, if you'd like to buy something that incentivizes the money manager or broker, not only will it be difficult for them to suggest a better alternative that's less lucrative for them, but they will even come to believe that the more lucrative alternative for them is better for you. Similarly, when we as investors get greedy, instead of seeing the true risk involved, it's easy for greed to cloud our judgment and pursue imprudent opportunities. What we expect to see. Expectations can cause even the most intelligent, experienced, and well-trained to overlook some startlingly obvious things. One recent study asked a group of radiologists to examine a series of chest x-rays, just as they would if looking for lung cancer. Now, unbeknownst to these radiologists, though, the researchers had inserted into the x-ray a picture of something no professional would ever expect to see: a gorilla. The picture of the gorilla wasn't tiny, it was about 45 times the size of the average cancerous lung nodule, or about the size of a matchbox in your lung. Though 83% of the radiologists missed the gorilla, even though eye tracking technology showed that most of them had been looking directly at it. Our preconceived notions. We often see this in election campaigns. If someone is a hardened liberal or a hardened conservative, they'll routinely explain away the foibles of the candidates they support while jumping all over the foibles of the opposition. Similarly, with investments or investment managers we like, we will explain away their foibles and even assume we're doing better than we are on our portfolios until we are forced to confront the cold, hard numbers. The gambler's fallacy. The gambler's fallacy occurs when someone believes that a run of a certain type in a random process makes a reversion more likely. A run of reds on a roulette wheel doesn't make black any more likely next time, but people persist in believing that it will. Equally, a run of daily losses on the stock doesn't mean that a profit is guaranteed tomorrow. The main reason for the gambler's fallacy is that people don't understand statistics, or at least don't realize when they're dealing with something that has inherent randomness. Some people use complicated charts to figure out trends in the markets, but ultimately it's a fool's game, as the markets are going to operate chaotically in the short term and in line with fundamentals of the broader market in the long term. In the short term, stocks and most markets are roulette wheels. But in the long term, they're typically reflective of their fundamentals. Make every decision as if the long term is the only option you have. Hindsight bias. Hindsight bias is our delusionary thinking that at some point in the past, we actually predicted the present. You ever hear people say, "I knew that would happen"? Many events, innovations, or concepts seem obvious after the fact. Unfortunately, it's usually not true. Something that now seems obvious was not nearly so obvious before it occurred. We only fool ourselves into thinking so, and through that misconception, we perpetuate a further delusion that we can successfully predict the future. We see this all the time. For example, after a prolonged period of solid returns, the market declines by 15%. Immediately thereafter, all kinds of experts appear in the mass media claiming that we were long overdue for a correction, as if the decline was obvious and inevitable. But where were these experts before the event? In reality, few take sufficient caution in frothy markets, and those that do take precautions are often the ones who predicted 11 out of the last 2 recessions. Hindsight bias also leads to our expectations of others being out of whack. I knew this would happen. Why didn't you? Once the reasons why an investment performed poorly are understood, it becomes difficult to understand why it wasn't avoided. A client or a spouse may complain to their husband, broker, or advisor that they should have seen it coming. The solution? Keep good records of your investment decisions. When considering a purchase or sale, write down the reason for taking that particular action, making notes on why you're doing what you're doing and what potential events could make your decision turn out poorly. If it turns out that you were wrong, you could always return to your notes and remind yourself what you were thinking before the events became obvious. This can also help restrain you from making impulsive investment decisions by creating a sense of accountability for your decisions and by explicitly laying out what you did and didn't know at the time of the decision. Plus, this would also be a great exercise in humility. If we can't effectively review our past decisions intelligently and don't realize that our past performance isn't nearly as good as we'd like to believe that it is, that will lead us to our next bias, the bias of overconfidence. Overconfidence. Overconfidence is self-explanatory. We tend to overestimate our abilities, overrate our place in the world, and believe that our views are much more precise than they really are. The irony is that almost no one believes that they themselves are overconfident. This has gotten even worse as information has become easier to access online. People can now easily locate evidence, so to speak, that confirms their hunches or theories, increasing the confidence in the accuracy of their predictions. So why is it that we're overconfident? Well, while overconfidence may not help us make better decisions, it does have other benefits. Firstly, it allows us to naively believe that we have the world figured out. Secondly, it casts a funny spell over people, as the average Joe or Jane is attracted to people with extreme confidence. In fact, when researchers analyzed people's responses to overconfident investment prognosticators, they discovered that the preferred advisors were the ones that expressed the most confidence about being right, even though they were frequently wrong. Similar to overconfidence is our illusion of control, which is a basic human need to feel in control of situations even when we have none. The problem with overconfidence is that it prompts increased activity or trading, and there's no shortage of research that suggests that frequent activity or trading leads to subpar investment results. And since overconfidence leads people to believe that they are better investors than they actually are, many investors don't even know how they're doing compared to the market. They give themselves far too much credit, and that leads to even worse performance. Loss aversion. Loss aversion demonstrates that our preference to avoid losses is stronger than our desire to obtain gains. In fact, we're twice as unhappy with a loss as we are happy with an equivalent gain. As a consequence, we generally have a negativity bias, a predisposition to regard negative events as more salient and potent than equivalent positive ones. This is because of the expression, a spoonful of tar can ruin a barrel of honey, but a spoonful of honey does nothing for a barrel of tar. Loss aversion can also ironically lead one to take way more risk to protect the things that they currently have. One such example is thinking short term. We know that over the last 100 years, stocks have returned almost 40 times the amount of money that corporate bonds did. The differences are so dramatic that one would think the risk is disproportionate to the return. In other words, the return on stocks far outweighs the risk difference. So why doesn't everyone have a larger portion of their portfolio in stocks? Simply because we don't think about stocks and evaluate stocks over the long term. We look at it 1 month or 1 quarter or 1 year at a time, over which period the results are entirely random. Social scientists have referred to this inability to think long term as myopic loss aversion. A clear example of this is, let's say I made a bet with you on a coin toss. If it's heads, you win $200, and if it's tails, you lose $100. Most people would not make that bet. But what if I propose that we do this bet 100 times? Who wouldn't do this? Well, if you are willing to do this 100 times, you should be willing to do it once. That's myopic loss aversion. Mental accounting. Mental accounting is the notion that individuals divide their assets into separate accounts and assign different levels of utility and different rules to each asset group, which affects their consumption decisions and other behaviors. We know that one of the properties of money is that it's fungible. That means that it can be used interchangeably. Money is money is money. Though, rather than rationally viewing every dollar as identical, mental accounting helps explain why many investors designate some of their capital as safe capital, some as risk capital, some as play capital, some as children's capital, rather than viewing the entire pool holistically. By employing these illusory boundaries to separate different pools of money leads to a whole slew of toxic behaviors. For example, various studies have found that typical households had more than $5,000 sitting in the bank and savings accounts, earning a few percent a year, while simultaneously carrying nearly $3,000 of credit card balances, carrying an interest rate of 18% or more. Instead, in order to optimize the strengths of one's portfolio and wealth, investors should consider all their accounts and buckets holistically, tracking all investments in one place. There isn't a pool of money that's more important or less important than others. There may be different job descriptions for different pools of capital, but it's important to remember that the varying significance of the jobs doesn't translate into the varying significance of the money. Recency and availability bias. The recency bias shows how we overvalue the most recent events experienced and neglect to place equal value on older information. The availability bias shows how heavily we weigh our decisions towards information that's more readily available than consequential. We worry about risks like SARS and mad cow disease, Zika virus, and terrorism because those most easily come to mind. But we don't worry nearly as much about broader and more cataclysmic risks and threats like inequality, inflation, cancer, car accidents, how we're raising our children, and so on. In almost all domains of life, the most recent news stories or experiences make us perk up without taking historic averages into consideration. So some of the results of these two biases are: we tend to overreact to news stories like Brexit or the Arab Spring or North Korea or whatever, that over the course of time will have no impact on our investments. We tend to pay more attention to recent returns than to returns achieved 8 to 10 years earlier. We pay more attention to the problems that we have faced in recent past and completely ignore those that we need to be considering, which is the problems we could be facing in the future. When unusual stories unfold, we have a hard time recognizing the probabilities of those events recurring. For example, people always buy the most flood insurance right after a flood, when the probability of that event recurring is the slimmest. Paying too much attention to recent phenomena creates much more anxiety and fear than necessary, which invariably leads us to abandon strategies and investments right when they are most needed. Costs of the biases. So what are the costs of our behavioral biases on our decisions? While the exact costs of behavioral biases are both unknown and somewhat unquantifiable, because it's difficult to measure motivation, there are a number of reference points which can provide some perspectives on the costs involved. Flow of funds, emotional versus non-emotional man, and the market versus investors. Flow of funds. The first reference point we can look at is the actual flow of funds. Here, researchers Philip Myman and Greg Fisher also wanted to figure out the cost of behavioral biases on investors. To do that, they measured inflows and outflows of 25,000 funds over a 15-year period. And based on the various news events that prompted loss aversions, recency bias, overconfidence, etc., by their estimate, these biases cost investors at least 1% per year. Emotional versus non-emotional man. The second reference point we can look at is the comparison between emotional and non-emotional man. So how do we do that? Well, in 2005, a group of researchers at Stanford University got together to study the impact of neurology on financial decisions, a field that they've labeled neuroeconomics. In one of these studies, they looked at how emotions impact decision-making, especially when risk was involved. In this study, they compared the decision-making of normal, quote-unquote, investors with the decision-making of people with damage in those parts of the brain that regulate emotions. What they discovered is that those with lower emotional response were far more rational about their prospects of success, making probabilistically positive bets almost twice as often as their fearful and emotional counterparts. And we'll quantify that momentarily. Market versus investor. The final reference point is the actual results of investor behaviors, which are generally governed by the combination of both intelligence and emotions. When we look at how the average investor fared over the last 20 years relative to the actual investments they themselves invested in, we see that they did far poorer. Part of this involves the fees they paid, but the larger part of it is due to the emotions that were thrown into the equation. Even if we take a shorter time period, say 10 years, and expand the range of investments, when we compare the results of the average investor, they collectively just barely exceeded the rate of inflation. And even if we broaden the range of investment opportunities to include all sorts of asset classes, we see that investors as a group are chronic underperformers to almost every asset class that they themselves are investing in. So when you add it all up, here's what each of these groups achieved. Going purely by the reference points I've shared with you thus far, if you take a $10 million portfolio, after 10 years, the average investor would have made $13.439 million. A sophisticated investor with some awareness of their emotions and biases may have made $15.604 million. A brain-damaged, emotionally deficient investor would have made $17.081 million. And the underlying investments, without the involvement of people, will have made $20.61 million. And by the way, in these calculations, I've assumed a diversified portfolio, which inevitably mutes returns. If it was a more concentrated portfolio, say just $10 million of equities, or if it captures any periods that are highly volatile, that difference would be even greater. For example, if you look at this study from Delbar and Lipper, just focusing on stocks between 1991 and 2010, that difference between what the market achieved and what the average investor achieved is a staggering 6.1% difference. On a $10 million investment over a 10-year period, that will average out over $1.2 million a year. So with this concentrated equity portfolio included, here is on average the difference in outcomes. Please bear in mind that these numbers are highly imperfect, and I would not rely on them for anything, but they are driven by the analysis and data I've provided thus far, just to give you a sense of the disparity in returns caused primarily by behavioral mistakes. Summary. So let's summarize everything we've learned thus far. We said that learning from mistakes rather than successes is safer, easier, and more efficient. We talked about virtually all mistakes being either structural or behavioral. Since all investors share emotional and psychological wiring, we outlined why we are all prone to make similar behavioral errors. We demonstrated why the costs of these behavioral biases are somewhat difficult to calculate, but undoubtedly significant. We talked about strategies for reducing behavioral biases, including increased awareness of them, inclusion of objective third party in all investment decisions, and repositioning our perspectives. And rather than going through the individual biases, I have provided a quick summary of all those that we spoke about for you to enjoy.